welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, GST has often been described as a work in progress, and as befits that description, the GST Council met earlier this month for the 27th time to try and iron out the wrinkles in what is undoubtedly the most significant reform undertaken on the indirect tax front. So, in this edition, we are going to try and take stock of the progress to date on the GST front. We'll start with the decisions taken at the meeting on the 4th of May and then go on to examine the performance on the revenue front and conclude with the challenges and what remains to be done. Joining me in the discussion are two experts who are veterans in the GST space. B.S. Krishnan, former member CBEC and presently National Leader, Tax and Economic Policy EY, and Pratik Jain, National Leader, Indirect Tax PwC. Well, if one were to start by rating the performance of the last GST Council at its last meet, well, the scorecard would perhaps read 2 upon 5. The tentative agenda consists of 5 broad points: simplification of the form, cess on sugar, discount for digital transactions, the status of the GST network and the reverse charge mechanism. And the Council came to an agreement on 2 of the 5 points. Would you call that good going, Krishnan?
Well, Mythili, I think the high point of the meeting was, of course, the return filing. And some of the other issues which were brought to the table, in fact, diverted attention from one of the most interesting things. So, I mean, I would say that the return filing simplification was really a major achievement and would take really the GST process forward, address a lot of the problems of the small, prevent the cluttering on the system by sort of segregating the compounded players and the nil filers. So, we now asked to file quarterly returns. So, I think it was a neat solution, a pragmatic solution. And the other issues in the agenda were things which could have been brought later, but they have been brought earlier. They are not part of the work in progress.
Okay, except the GST itself is a work in progress. But Pratik, would you agree with Krishnan's assessment? Because on 2 of the other issues, that is the sugar cess and discount on digital transactions, the Council has decided to set up a GOM, a group of ministers. Is that the way to go, or is it merely a means of buying time? And how hopeful are you of the Union and the states finding a solution here as well? Pratik?
Yeah, so Mythili, on these 2 points, on sugar cess, it's good that they have created a GOM, because to my mind sugar cess was never a good idea to start with, because when GST came in, cess was done away with, and now if you're introducing a cess again, you might as well want to think about it carefully, because if you start with sugar cess now, what about auto cess, what about other cesses, and what happens if the states start demanding that they want to impose cess as well. So it's good that group of ministers will deliberate on that, and I hope that eventually they don't introduce cess at all. I mean, I think it's a step in the backward direction if you look at 10 months of GST and where we need to go. As far as digital transactions are concerned, I think while it's important, but it's not that urgent, right? And then there are a lot of mechanics to be worked out in detail as to what will be the limit, which are the items which will be exempt, which are the items which will be entitled, how will you credit the customers, and so on and so forth. So I think I'm happy that both of these things have been referred to GOM. It's not very critical in any case. And coming to the return part of it, I think it's a major achievement, as Mr. Krishnan has said. And I'm particularly glad that they're not doing it immediately. They're first giving a 6 months for the current system to continue, then another 6 months for the provisional credit to continue, and after that to introduce the revised guidelines which they're working on. So I think this is the right way to approach. They've obviously learned from the past mistakes that they've made, and hopefully it will be much smoother as we go along. So I'm pretty okay with the decision that they have taken in this meeting.
Okay, so pretty good going so far. But let me now shift to the specifics, Krishnan. The new form should make compliance easier, not only because taxpayers will now have to file only a monthly return as against the earlier 3-stage return filing process, but also because it actually does away with return filing per se and replaces it with invoice uploading. But the change, as Pratik mentioned, cannot happen overnight and there will be some initial hiccups. What are the hiccups that you foresee, and will we be able to move to the new system in the time that has been given, effectively 1 year, that is the first and second period of 6 months each. So, do we have a 3-step process? Is that enough? What is your view on that, Krishnan?
I think, Mythili, the key insight which Nandan gave in his presentation was, what was complicating the whole system was trying to match the invoices through the system. And Nandan's interesting idea was that the buyer and the seller have an incentive to come together and ensure that whatever invoices are uploaded, credit is taken on them. So the whole idea is to make the buyer persuade the supplier to upload. That is the critical thing. Now this makes the whole system functioning much easier, and that's what they have done. They have also addressed the problem of system overload. In fact, by segregating the nil filers and the composition filers, they will be filing quarterly returns. Even the other filers, the regular filers, both small and large, they will file a monthly return. They will pay duty monthly, they will file returns monthly. But there is a possibility that within the month, their timelines may be different. The large filer may file, say, by the 10th of the following month, while the small filer may file by the 20th of the next month. It will be a monthly filing, but with slightly different dates, and I think that's again a pragmatic thing. And the important thing about the monthly filing for both small and big is that it enables the large buyers to buy from the small by enabling them to reconcile the credits earlier. If the small were to file on a quarterly basis, the large were finding it difficult to reconcile credits. So there is an incentive here for the big to buy from the small in the B2B space. That was the worry of many people like Indra Rajaraman when she wrote about this, that the GST should not become an instrument where the large B stops buying from the small b. Now this similar periodicity will enable this to happen, the small b, big B transaction, and also easier to estimate the revenue. Because if you file a monthly return, if everybody files a monthly return, you get a fix on revenue quickly. So I think a very good job done, and as Pratik said, we have learned from the past. These system related changes should not be implemented in a hurry. Same thing happened in the e-way bill. It crashed and then they gave it time and now it's working. So give some time to the systems people to sort of fix it up, and meanwhile for 6 months the existing GSTR 3B and GSTR 1 return system, which is stabilized now, will continue.
Pratik, though the idea that every seller will upload his invoices and the system will do the matching seems a great idea. In fact, Indians are notorious when it comes to complying with anything. So will buyers find themselves at the receiving end once self-certification is scrapped at the end of the second phase, and buyers don't get the benefit for purchases where the sellers don't upload their invoices? Does the new regime, where the return is automatically generated based on invoices, call for a degree of sophistication that the GSTN is unlikely to be able to meet? And is industry really ready for the change wherein buyers suffer for non-compliance by sellers?
Yes, you have a point there, but if you look at the press release which the government has come up with, they have said that after the new system comes in, which is after a year from now, you don't have any reconciliation at all, right? So you just look at the invoices uploaded by the vendors and you go ahead and claim the credit. Now the problem is that the vendors are non-compliant, the buyers suffer. But one important departure which they have made is that if tax is not paid by the vendor, so let's say vendor has uploaded the invoice, I as a customer have claimed the credit, but vendor does not pay tax. Earlier, as a purchaser, you have to reverse the credit along with interest, and now it has been announced the government will proceed against the vendors only if the vendors are not to be traced, or in exceptional situation they will reach out to the buyer. That means the onus of paying tax is on the vendor, right, which is a major departure from what you had earlier. Yes, the only problem I see with this is that larger companies would want to deal with larger vendors because they would be more confident of the compliance levels of the vendors, and therefore it could hit the SMEs hard unless the SMEs really sort of over next few months get their act together and ensure that level of compliances increase. But overall, I think it's a much better system. You're not doing the reconciliation through the system, you're doing the reconciliation offline, which was a major problem in the earlier system. So we'll have to give it time to see, how it settles. But clearly, it's a much improved and much robust mechanism of filing returns.
Krishna, that's right. What Pratik says is entirely right. But the fact is that will the compliance cost really increase or decrease? And will the systems actually stabilize faster once we have agreement on the reverse charge mechanism? Or are the two not linked at all? And for the benefit of our viewers, can you very briefly explain what the reverse charge mechanism really means? How does it work? Because you said the small b will be happy, but the small b now has to file on a monthly basis. So will compliance costs increase for the small b?
Actually, the reverse charge mechanism now, Mythili, is there for some sectors. For example, the logistics providers, the transportation sector, the user pays the thing on behalf of that. The whole idea of the reverse charge mechanism is, ideally the reverse charge mechanism should have been only for imports, because when you import, the IGST is paid on a reverse charge basis. In fact, there should have been no reverse charge at all for any domestic sales. But because of the whole legacy where certain sectors didn't want to come within the tax net, the reverse charge mechanism was visualized so that the bigger buyers get registered and pay duty on the behalf of the unregistered and take a credit on their self-generated invoices. Now, what they are thinking of as a reverse charge mechanism is basically for the compounding units, because the revenue that's coming from the compounding units is very, very small. So what they are thinking of was whether the buyers from compounding units, whether they can come on a reverse charge mechanism is something that's being explored. But that's a separate issue. The RCM is not really linked to the simplicity of the return filing mechanism. This system has a better chance of success because they have also addressed two important problems which were sort of nagging, technically which was a nag. First was trying to match through the system itself. That's been now done away, and the kind of matching will be done offline. So that takes care of it. Secondly, they have segregated the nil filers, who are a substantial number of the total registered units, and the compounding on a quarterly basis, so that it doesn't clash with the regular monthly filing. I think with these two steps, I think the system will stabilize quickly, and sufficient time has been given to do this. And in the last final phase, in fact, the system will generate the credit and also determine the tax liability, which is why you don't need a GSTR 3. So you have one GSTR, when some additional columns will have to be added, like taking provisional credit and all that. So I think this system is an extremely robust and a good chance of succeeding, because it addresses the problems which were sort of impeding the smooth flow of the system.
Okay, so the verdict so far from both Krishna as well as Pratik is this is a far better system than what we had earlier. But I'm afraid it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the progress to date on the GST route with Mr. V.S. Krishnan and Pratik Jain. And the verdict so far is that's been pretty good going so far. But Pratik, do you foresee more problems in the B2C segment or the B2B segment, and why?
I mean, look, as far as B2C segment is concerned, I don't see too much of a problem there. Of course, from a government perspective, catching those transactions and ensuring that tax is paid is more difficult, right? Because the B2B transactions are all recorded under the system, and unless the seller pays tax, the buyer does not get credit. So therefore, there is a self-policing mechanism for B2B. For B2C, that self-policing mechanism is not there in the law, and also because there is a large number of dealers who have opted for composition, and practically the government is not getting any tax from those businesses, and there are something like over 15 lakh people who are registered for composition. I suspect that there is a large amount of evasion perhaps which is happening in that segment, which is really the B2C segment. So I think B2C segment is more problematic from the government standpoint to ensure that there's no tax leakage. That's not the case in B2B. B2B segment has, over a period of last 10 months or so, they have adjusted well with the new system and with the simplified return mechanism. I don't see too much of a challenge on that front. Yes, there are a couple of sectors which are still out, and that would mean that still there is an arbitrage somewhere available. And you have complicated the tax system by having, let's say, on restaurant 5% tax without input credit, etc. Those are the cases where even a business is incentivized to kind of go out of the system of GST and purchase from people who are not paying proper GST, and therefore over a period of time we should try and sort of correct those shortcomings. But overall, I think from a government perspective is B2C. B2B has fairly well adjusted, I guess, should not be a problem much from a business standpoint.
Krishnan, let me move now to a next item on which there was agreement: the ownership of the GST and the information technology backbone of GST. As against the present structure, the Council has agreed to make it a predominantly government-owned body, with government acquiring 51% stake that is presently held by private entities in the GSTN. Subsequently, the central government will acquire 50% stake in the GSTN, while the state governments will collectively hold the remaining 50%. Is that good, bad, ugly? Why? And what is the rationale? And are the arguments that drove the initial ownership structure, greater flexibility, efficiency, etc., no longer relevant? Krishnan?
Mythili, the main worry, was that one of data privacy, and that there's a lot of data which is there, and the idea that data is safer with a government company. I somehow don't buy this argument, because I was associated with I was on the GSTN board. The main idea of making this GST 49% government and 51% private was to really ensure that top flight talent could come, and that the GSTN is also saved of these day-to-day intrusions of the 3 C's, as they say. But it has been agreed, even with the present formation of 49-51, that the CAG would be allowed to look at the working of this. So I see no reason, and the data protection, in any case, most of the chairmancy, the appointment of chairman from the government ranks, and even the banks, many of them are, LIC and all are with this considerable government participation. I don't think that it's a very good idea to move into this, because slowly you will find a flight of talent, and you will also find more intrusion, less flexibility, and the kind of creativity and innovations that is possible in this kind of a setup. I think it is a bad idea.
Okay, that's quite a damning confession from a former bureaucrat, Krishnan. But Pratik, what is your take on the rationale of the change? Do you agree with Krishnan that we're going to be worse off, the GSTN is going to be worse off with government ownership than under the present system? Pratik?
See, from a business perspective, Mythili, it doesn't really matter, who owns GSTN. Frankly, I'm giving you an industry standpoint, views. It doesn't really matter. All we want is that GSTN should function professionally, independently, and they should have flexibility in operations. And I think while they are moving it to be a government body, and data security could be one sort of driver for that, the fact remains that for 5 years they have said that the existing terms of the employment of staff will not change. That means that whatever differential is there vis-a-vis other sort of government companies, that will continue. And they have also said that there is the flexibility, the way it has been operating, that will continue as well for 5 years. So long as you can achieve that flexibility, the flight of sort of talent that Mr. Krishnan were talking about, perhaps can be managed. So I would say I'm quite neutral to that. I don't think that really the functioning of GSTN has anything got to do with the ownership of GSTN. The only thing is that the flexibility that they're talking about for 5 years, that should be really implemented in letter and spirit, because if that flexibility is not there, then we might have a challenge, because GSTN by definition means technology. That means sort of being nimble in terms of making changes, and it means people come from outside, maybe from private companies at a higher compensation perhaps. So those kind of flexibility will be very important. Otherwise, we really don't have a problem if it is government owned or private owned.
Yes, in fact, but there I wouldn't quite agree with you, Pratik, because generally speaking, government ownership is not conducive either to flexibility or to being nimble-footed, and that is the reality, unfortunately. But Krishna, we will come back to the issue of the sugar cess. Given that one of the key arguments, as we discussed in this program itself, was that the GST would basically subsume all kinds of cesses, the only exception perhaps being compensation cess on demerit and luxury goods, to deal with really revenue shortfall. Does the idea of even setting up a GOM threaten to dilute this very core principle, Krishnan?
In fact, I mean, as Pratik also said, it's a terrible idea to again bring the cess back to the table. I think, I think the whole problem of excess arrears to be paid by these companies can really be addressed by a change in the sugar policy. The sugar policy today, you know, says that the cane should also only sell to people in that area, and all the kind of zoning laws. I think the problem lies elsewhere, and the cess is not the way to go about to address the core problem of why arrears arise in the first case. And then you're going to open a Pandora's box. The Kerala Finance Minister says, I'll agree if you agree for rubber, and then and so it goes on. And then also, when you're looking forward to rate rationalization. You're looking forward to, you know, telescoping the rates, you know, maybe the 18 rate and the 12 to somewhere to 16, bringing down more items from 28 to the lower rates. And what is important is this is rate rationalization, and to get again into these cess issues, and you've cleaned up the whole thing, why get into it again?
But Krishna, let me now move to an area that you are very familiar with, that is targets and collections. The achievement of the March revenue collection of more than rupees 1 lakh crore has been widely welcomed, and there is a sense that we've got over the worst of the problems with GST. Do you agree, or is it the usual year-end bump in collection? And is the target for the next year, 12 lakh crore, really feasible, Krishnan?
I think it's actually a mixed picture, Mythili. I think the revenues have bounced back. But a lot of the March figure also contains some amount of arrear payment. So the March figure may not be representative of the whole year. But I see grounds for optimism on the revenue front. And the reason is that first of all, there is a bounce back in the economy, and a lot of number of parameters are going up, which is why you are seeing this bump in revenue. Revenues picking up, despite the rates coming down on a number of items. And I think as the return simplification sort of also improves, and you'll find more and more people filing returns and paying taxes. And one interesting thing is that the gap between the CGST and the SGST is really an indicator of what the potential normal revenue will be. Today, roughly the CGST is about 22,000 crores a month, and the CGST is about 18 to 19,000. Actually, both should be at the same level. There's about 6,000, 7,000 crores gap in CGST revenue, largely on account of the transitional credit. Now, as transitional credit, the things are sorted out, you'll find CGST revenue going up and moving towards the SGST, which is where the normal revenue will come in. Of course, the IGST revenue contains a lot of the export refund. So once you factor in for this, you will find buoyancy picking up, because basically the whole chain, once it's set up, and if you sort of bring in the remaining items which have been left out and face some of the exemptions and really move towards what is a more ideal GST, you'll find the revenue boom even more.
Okay, so Krishna is rather quite optimistic, I would say, Pratik, but we're running out of time. So very quickly, what really remains to be done, and what are the chances that the exempted items will be included before the elections, the general elections, Pratik?
What remains to be done? I mean, a lot. I think a greater focus on tax administration is required. You still see different authorities, different states going in their own direction. You need a lot more to be done on strengthening the advanced ruling and dispute resolution mechanism. On the rate of tax, I would expect a lot of items from 28% to move down to 18%, either before the election or after. But really, I mean, 28% is really an exception, which would have been only there for those 4 or 5 products which initially was contemplated. That's that. There are some legislative changes which they have been working on, and businesses are looking forward for those changes in the next session to come in. So I think there's lots, and anti-profiteering, last but not the least, some bit of guidance on that is required as well. So lots to be done. I mean, I am with Mr. Krishnan when he says that there are ground for optimism. Things are stabilizing, and hopefully now we would look at the finer aspects of GST and try and improve it. And the second year of GST must be much better than the first year.
Good way to end, because I am afraid we run out of time completely, and the verdict both from Krishnan and Pratik is that we've done a pretty good job so far, but there's a lot still left. Thank you so much, Pratik and Mr. Krishnan, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us on ET Now. And of course, given that it is GST, we will soon have Krishnan and Pratik back once again to tell us how far again we moved down that road. Till then, it's thank you and goodbye from all of us at ET Now.